analyst at Forex Live. Adam, thanks a lot for joining us. It's been a soft year for the loonie so far. The dominant influence, you correct me if I'm wrong, but the dominant influence, I think, is perceptions of the U.S. Fed, the Bank of Canada, who eases first, who eases by the most. The market, of course, judges that the Bank of Canada eases first and eases by the most. What gets the loonie further down to 70 cents or below by the end of this year?
Right. I think now we're starting to see the cracks in the Canadian economy. We had a soft retail sales report most recently. The housing market, it looked strong early in the spring, but it's really flattened out. I think there was a lot of hope about it picking up further into the summer or on a rate cut, and I just don't think that's going to be the case, especially with the Bank of Canada signaling really a tepid or a slow pace of rate cuts thus far. There is a lot to like about the U.S. economy on the other side. In the global scheme, Canada hasn't done that badly this year, but the U.S. economy has really outperformed. We came into the year thinking, well, both economies would be at about the same level, but it's clear now the U.S. economy is much stronger.
When do you see it? What's your reaction to the Fed's moves of yesterday, Fed's signaling of yesterday? One rate cut now in the cards, according to the dot plots, not two.
Yeah, we're seeing this really persistent strength in the U.S. dollar today. That decision or announcement came in between a couple of inflation reports that were soft in the U.S., and we've seen the market try to sell the U.S. dollar a couple times. But instead, it's really firming up and it's strengthening even this morning. And the market's just saying, listen, the Fed signaled now it's in no rush to cut rates. So by the time they do get around to cutting rates, things will have to be significantly worse. And again, the U.S. economy is looking pretty solid, though we're watching the data. The market is trading on every data point right now. We're looking for that turning point in the economy. I think it's here. It's very clearly here in Canada, but that's a tougher call in the U.S.
Yesterday morning, before the Fed made its announcement in the afternoon, you wrote in a note to clients that if the Fed is dovish today and signals two cuts, it will be a green light for a more dovish stance from the Bank of Canada. The Fed, in effect, will give the BOC permission, quote unquote, to signal a rate cutting cycle. That didn't happen. The signal was one cut, not two. Circle back to that issue. What is the takeaway here for the Bank of Canada from what the Fed announced yesterday?
I mean, there's a massive amount of groupthink in central banks, and it's really led by the Federal Reserve. And right now, the groupthink is saying, listen, we need to be really careful about cutting rates too quickly. Central bankers always fight the last war. And if you look at the Canadian data, we're at 4.75%. In any other time in the last 15 years, we'd be much lower than that, given the totality of the data. And they're reluctant to really go because they're looking at the past inflation. They're also looking at the Fed and those U.S. numbers that haven't really dropped enough to be comfortable yet. And the Bank of Canada doesn't want to really break out and say, you know what, our economy's not great. We're a housing-dependent economy that's over-leveraged. And we need to get rates much lower here to have any kind of growth in the coming years. But they just don't want to pull that trigger yet. And I'm hopeful that the Fed will give them that permission because they're getting increasingly behind the curve. If we get to the end of the year at, say, 450 or 425, so 25 or the 50 basis points that's priced in right now, I think we're in for a really tough year in 2025. And the currency market is looking towards that right now and making that call.
Do you believe the Bank of Canada should have cut earlier than it did? Should have begun the rate cutting cycle earlier?
It's abundantly clear to me. I mean, the numbers are what they are in Canada, and the situation in the economy, it's so much different from the U.S. with the state of the mortgage market. I get that they're reluctant to reinflate the housing market, and I understand that hesitancy to fuel inflation once again, but it's time now, and it's time to be aggressive and signal to the market that rates are coming down. Now they're doing that. They're saying we will cut, but only if there is further progress and more sustained progress. And we don't really have an idea of how much more progress and how quickly they might cut, which brings us back to the data.
What about the Canadian dollar? That's what we're talking about here. The Bank of Canada surely must be mindful that if that its cuts and the policy divergence between itself and the U.S. Fed could significantly weaken the dollar. That's what you and I are talking about right now, and therefore have the effect of importing inflation from the United States. The purchases that we and businesses in this country make from the United States become more expensive with a lower Canadian dollar. That can be a positive, an upward influence on inflation.
Yeah, and they are cognizant of that, and that's why they need that green light from the Fed. But they're also in a situation where they're going to have to pick their poison, because if they don't cut soon enough, the growth in this country is going to be a big problem. So, ultimately, they're just very shy about COVID and what happened. It was interesting. The title of his speech yesterday was, central banking in a new world, or navigating a new world. And they really believe that more and more supply shocks are coming and rates can't come down. Whereas I argue that the supply shocks are coming from technological change and AI and the massive job losses that are coming from that. And they need to be more eager to cut. The world hasn't changed. It's still a disinflationary world. And they are behind the curve. So, now is the time, and it's overdue, but that's not what's going to happen. And that's why the Canadian dollar is going to suffer, because the growth side of the equation is about to get much poorer, with housing stalling out and immigration probably stalling out as well.
Okay, you are not bullish on the Canadian dollar. What do you see among other major world currencies, the euro and the pound sterling, for instance?
The drama right now in Europe it's pretty intense. You showed the equity moves in Europe before I came on, and the politics in France has really come undone, and there's just a sea change that's happening there in just a chaotic way. I think ultimately that may prove to be positive for the euro, but to get there, that might be a year or two out. If you look at the UK, again, the market's not liking what's happening there. And all roads ultimately lead back to the US dollar. US technology is dominating right now. Money is piling into these companies at an amazing pace. The US still has fiscal room, even though it's running hot. And the political challenges there, as insane as they appear to be, we've seen them before. So the market believes it can deal with that. So it's really, really difficult to be in anything but US dollars right now.
Adam,